Fellow risk takers, this is your worst. Podcast host Andrew Stotz from A Stotz Academy, continuing my discussion with Larry Swedroe, who for 3 decades was the head of research at Buckingham Wealth Partners. You can learn more about his story in episode 645. Larry is unique because he understands the academic research world as well as the practical world of investing. Today, we're going to discuss chapter 7 from his recent book, Enrich Your Future, The Keys to Successful Investing. And that chapter is titled The Value of Security Analysis. Larry, take it away.
Yeah, so I think one of the things, a way to test the efficiency of the market would be to look at the security analysts and see how good they are at predicting the future. And if they can outsmart the market, then the market's not really efficient. You can generate alpha. So it's an interesting question. How good are security analysts? Well, we have a hint at that by looking at the performance of actively managed mutual funds, right? Because they rely on analyst forecasts, right? And then seeing if they think stocks are cheap or not. And we've discussed many times that evidence is very weak. Actually, the funds tend to generate a little bit of alpha on a gross basis because they're able to exploit naive retail investors. But after the expenses of the effort, they end up with significantly negative alpha. So that's really what matters, is not whether the price is right or not necessarily, but can you exploit any inefficiency then in order to claim the market was inefficient. So a great experiment was done, I thought, and that's why I put it in my book, by a UCLA professor named Brad Cornell. And this was in May of 1999, and Cornell presented this study. And here's the case study. So the Intel is the company, and the board of directors is sitting with a big cash load of $10 billion. And they want to know what to do with it. So their choices, of course, one of them could be to pay a big dividend, right? If we can't earn our return on capital, we should return it to our shareholders. Another option, if the stock is overpriced, based on what the board thinks the earnings outlook, et cetera, would be, right? Then you ought to issue a ton of stock, take advantage of it, and get cheap capital. And if you think, right, that the stock is undervalued and it's trading below, then you ought to use that cash to buy the stock. So those are your three options, really, that you could exercise here. So Cornell said, all right, how do we value a company? We take the earnings forecast or stream of earnings, right? And then we discount it at some rate. And the discount rate we use is the risk-free rate plus a risk premium. So what risk premium do we use? It's an interesting question because even with the stock market overall, it's very time varying, right? In bear markets, the risk premium goes up because people perceive risk go up, and therefore you get higher expected returns. And in bull markets, the reverse is true. Over the long term, on a compound basis, the risk premium has been in the US about 7%. Got 10% return on stocks, about 3% on T-bills, okay? So Cornell says, well, let's see what discount rate we use. Now, the market was at much higher prices at that time, right? This is May 99. And Intel was trading at 120 per share. So he says, well, let's take the analyst forecast that's publicly available and determine should we buy the stock or not. Well, you got to ask what discount rate. And Cornell showed that if you applied, say, a 5% rate, the stock would be about fair value, 120. But if you applied a 3% discount rate, then the stock is worth 200 and something. If that's true, you ought to issue as many shares as you possibly, sorry, you should buy up as many shares as possible at 120 because it's really worth 205. Okay. But what if you applied the historical rate of 7? Well, now the stock is worth 82. And you better sell as many shares at 120 and raise more capital, right? Well, what we do know is what happened. And what happened is over the next 10 months or so, Intel stock soared, right? The market peaked in March of 2000. But the stock then collapsed. I think it got as low as about 10. It didn't get back to where it was until 2014. And today, I think it's still trading at roughly the same price or below. It's certainly well below the high. So here you are, the board of directors. You have all this insight to what the earnings you think are going to be. But how do you know what to do when you don't know what the discount rate is? Because first of all, it's time varying. You could put your best guess on it, but even for the overall market, let alone for Intel. And that's why it's such a tough decision. How does the board know what to do? How do analysts know what to do? Your best assumption is to let the collective wisdom of the market make that decision and say Intel is the right price. Now, the last thing we want to just cover here is there was a study done called Analysts and Anomalies. And they looked at the analysts recommend in favor of stocks that have the positive attributes of these anomalies, or do they recommend the other side, right? So, for example, momentum. Are they recommending stocks with positive momentum? Are they recommending value stocks or highly profitable stocks? Stuff. Interesting, they found that the analysts on average tended to invest on the wrong side of anomalies, which really surprised me when I saw that, especially given that we know that even mutual funds do outperform by a little bit before their expenses. So that's the bottom line here. People who think they can outsmart the market, they're basically saying, I can predict, one, the earnings better than everybody else, but then I can also predict the equity risk premium. And there's nobody really that I know that can predict it well. In fact, the greatest investor maybe ever, Warren Buffett, said you should never try to time the market. But if you do, buy when everyone else is panic selling. That's when the discount rate is high and you have a high expected return. Of course, the risk could show up and stocks could crash a lot further. You don't know. It's just the market's best guess. And when stock prices are high, like they were in March of 2000, then only thing you know is that expected returns are low. But stock prices were high in 95, 6, 7, 8, 9, and the market kept going up. So trying to time the market is not likely to be a winner's game.
And I'm going to work backwards from what you ended up with, which was how it was a little bit baffling that analysts were coming up opposite of the anomalies versus the evidence that fund managers have, without the fees or other things that you can see they have some skill, possibly. But the point is that analysts are under very different pressures from fund managers. Fund managers, their net asset values published every single day. And in a way, analysts are, trying to make noise and make, extreme calls at times. And so I could see that, analysts are kind of disconnected from the actual recommendation performance of what they're doing.
Yeah, well, we know that's certainly what happened in the dot-com bubble.
Exactly. Now, I want to talk about this Intel story a little bit because there's two things I want to go through. One is, what discount rate should a person use? Now, for instance, one of the things that I've seen is that you have recency bias. Interest rates were really low, and people came to me and said, Andrew, how do you value a company when the risk-free rate is 0? And what, it's a part of what I'm trying to tell them is that when you're valuing a company, you're valuing its cash flow for a lifetime of that cash flow, and you're going to discount it at different rates. 12 months from now, it's going to be a different rate, and you're going to tell me, what do I value it now? I value it at 1%, or interest rates went up to 5. And you see so much volatility and variability in the discount rate. In the Intel example, would it have better to just have said, well, 10% is a long-term average for stocks on average, and therefore that's what we should have used? Or
Yeah, there's no good answer really to that question. I'll give you my whatever insights I think I can provide in this way. As countries evolve, like the US has over the last 200 years, it's become much safer to be an investor, right? First of all, we didn't have an SEC until 1930s. We didn't have a Federal Reserve to dampen economic activity and help us avoid recessions and depressions. There was no Federal Reserve until 1913, I think it was. And we have accounting standards kept getting better, right? And then we get regulatory rules being passed and bills, that force more disclosure and forcing you to announce, shareholder purchases and stuff. Hedge funds have to report all this stuff. And so that has made it, safer to invest. And on top of that, what's happened to the cost of investing, Andrew?
oh, it's been driven down.
Way down, right?
Yeah.
So if you're getting to keep more of the returns on your investment, starting from the gross, right? If you're paying 5% to buy a mutual fund or trade a stock, right? You're going to demand a bigger discount rate to make up for that than if you could pay, 2 cents bid offer spread and no commission, right? And if the expense ratio on mutual funds comes down, so now you can buy, a Schwab ETF of a total market for 1 or 2, basis points a year. So I would argue those things alone have driven the equity risk premium down. And then we know also that as countries become wealthier, what do you think should happen to the equity risk premium?
In theory, I guess it would come down, that stocks
Right.
become less risky and more
Well, it's
reliable.
not that stocks become less risky. Think about where capital is more available in Kazakhstan or France or England or the US.
Right.
Right? When you have a shortage of capital because you're very poor, or people are afraid to invest because of lawlessness and those things, well, then capital is going to be very expensive. You think about what the borrowing rates were, in the Middle Ages, they were higher than they are today. So as countries have become wealthier, the equity risk premium comes down, and we have evidence of that as well. So my own view is, you could think about it this way. The Cape 10, the long-term average of P has been about 16, but it's been creeping up over the last 50 years. In the last 40 years, I think it's averaged in the low 20s. So what's the right number? The now roughly 17 long-term average, or the last 40 years of 22? Now invert 22 and you call it 4.5% equity risk premium. To me, that likely seems more logical. And then COVID hits and prices collapse, and no one knows if you're ever going to get out of this, or half the world will die, and the risk premium jumps. So risk premiums are time varying, but I think we at least have some evidence to think about, when they get excessively high and excessively low. But I do think the risk premiums have come down, and we should not expect to get the same historical return unless prices go way down again. And because if you look at the 7% real return to stocks, take that 16 or 17 Cape 10, flip it around to get an earnings yield, and there's your 6 or 7% equity risk premium. So
Mm.
it's not a coincidence. Right. So if we get prices much lower again because of a recession or a war or geopolitical risk or whatever, then I would say the equity risk premium again is higher. But today, US stocks broad, I think it would be much safer to assume that the equity risk premium is more in the 4 to 5% range, maybe overall. Small value stocks are trading at about their historical averages. So they may be still trading with another maybe 5 or 6% premium on top of that instead of the historical 3% premium on top of that.
It's such a quagmire when you go
Yep.
into because I've read through the books on equity risk premium. I've seen they've had seminars and all kinds of stuff to go through it. And it's just such a quagmire that I've kind of stayed out of it. And I try to think about just what's the discount rate. I noticed today, 2 days ago, Ashwath Damodaran,
Yeah.
famous in the world of, I read pretty much every book he wrote about valuing companies, and he puts out an equity risk premium thing every year.
Right.
And I'm kind of surprised at how, people really rely on this. And let me just
Yep.
look at what it says for US. He says US equity risk premium 4.11%.
Well, there you go. That's roughly in line with what I have said. Now, but look, today, if you look at the S&P 500, I think you're talking a PE in the low 20s, which would correlate to his, 4.1 or 2. But look at small value stocks. You look at the fund that I own, Avantis's US small value. I think the PE is about 10. Well, that's probably below the historical average, which I think is about 12. So maybe, people obviously think that small and value companies today are riskier than the big growth stocks. Everyone's infatuated with AI and stuff. And, so those stocks have higher expected returns. Whether you actually earn them or not, we won't know for another 10 or 20 years, or whether the risk shows up or not.
It's an interesting point. I went to the website there of Avantis for that fund. I'm just looking for the PE, but I know the PE in the US in small caps is, let's say outside of the top 10 or 20 stocks is really, half the level of, let's say, S&P 500 or
Oh
the top
yeah,
10.
the top 10 PE might still be in the mid 30s or something. If you're on Morningstar, if you click on the portfolio tab, it says
Okay, let
you'll
me just
find
do
it.
that.
If you read the bar across the top, there's a performance tab and then there's a portfolio.
Yep.
The portfolio tab will get you the the PEs and the price. Take a look at the price to cash flows, which I think is a better measure of, because you can manipulate earnings, you can't manipulate cash flow, right?
Right. Yeah, I don't get all that on Morningstar because it's asking me to subscribe. So I have to think about that one.
All
But
right.
I
I'll pull it up while you
yep.
make a comment or two, and
So
I will
so
tell.
the thing that I've come up with the equity risk premium is first thing is that if there's so much volatility, because also you got to factor in when you're discounting a company, you got to factor in the risk-free rate, the equity risk premium, and then the beta or the riskiness of that stock. Let's just say if you use the CAPM as a framework. Now, I basically tell my students, forget about the CAPM framework, just try to understand what the discount rate is that you're using. It's a little bit like Yogi Berra is saying about, how many slices is that pizza? And they say it's 6 slices. And he says, well, just make it 4. I couldn't eat 6 slices. I'm not that hungry.
Yeah.
It doesn't matter how
Well,
you slice it. What matters is you get the
uh,
right discount rate.
well, the first thing I would say is the CAPM is dead and has
Hmm.
been dead for 30 years.
Yep.
So you have to look at not only the market beta premium, but then look at size and value
Yep.
as well in considering that there. And in this case, the Avantis small value ETF has a current P of about 10.8 and a price to cash flow of about 4.7. I
Mm.
mean, these are cheap stocks, today. But that's very different than, what the S&P 500 is. If you give me a second, I'll tell you
Yeah.
what the
So
same data is.
incredibly cheap. In fact,
Well, that's probably, economy, not in a severe recession, but it's not a depression type. When you get like in '08, you might see PEs in the 6 to 8s.
right.
So the market, the S&P 500, they're showing at 21.6 and a price to cash flow of 14.4.
Oh, well, certainly relative, it's cheap. One of the interesting things too, I've seen a chart recently that shows that it's about 20 or 30% of small or mid-cap companies are losing money in the US.
It's more than that. I think it's 40%.
It's incredible. Yeah.
Yeah, by the way, the Vanguard Growth ETF is trading at 31 times earnings, and their price to cash flow is over 19.
So where does that small cap value, or those, there's different ways. In the back of the book, you have a lot of great examples of funds and ETFs that can give you different exposures. How aggressive should someone be at trying to say, okay, I know I can't predict the future, but I would say that gap between the top companies and the bottom or mid-size, good companies, let's say value quality type of companies, is massive. What should I do?
Yeah, it's a good question. For some people, the answer I think should be nothing.
Yep.
And for others who are bolder and have a strong belief system, you should back up the truck, as they would say. So, and the reason is this. We have very strong evidence, and this is logical. Exactly the same thing happens with stocks as it does with, say, the value premium. Okay, so what do I mean by that? When the PE ratio is averaged about 16, 17, stocks have gotten about 10%. When the PEs average about 20, stocks have gotten much lower returns. And when the PE is averaged less than 10, stocks have gotten much higher returns. So valuations clearly matter. But here's the important message. When the PE is over, say, 20, you still could have the next 10 years have high returns. It's just that the distribution of returns that can happen has now shifted entirely to the left. So the median has come down from, say, a risk premium of 7 down to 5. The best returns have come down from, say, plus 15 to plus 10. And the worst returns have come from like losing 3% a year to losing 6% a year. The whole curve is shifted. Well, the same thing is true with the value premium. When it's averaged about, let's say, 3.5 or 4%, something like that, right? But when the spread is wider, like it is now, and it was in the late 90s, the value premium was much larger. From 2008, the value premium was double the historical average. Something like that. Maybe even more than that. It was the largest premium ever. But, right, the last 3 years, growth stocks have just gotten more and more expensive. So if you're going to panic and abandon that because you've had 3 years it doesn't work and you think 3 years is a long time, then don't try. But the expectation should be today, the expected return to small value stocks, at least those that are profitable. So you want to screen out the junk stocks. That's the stocks that the average typical naive retail investor tends to load up on and institutions avoid. And the retail investors lead that to be overpriced. Okay. And DFA and Avantis and Bridgeway and BlackRock and others have been screening out those stocks for decades, we've talked about, because the research shows you should avoid those stocks. So if you're a believer like me and can stay the course, so for example, I was a value investor, about 2/3 value, about 1/3 market in 95.6. 98 came. This is now 2 years after Greenspan said the market was irrationally exuberant. And I said, valuations are getting, to me, way too high. I know it could get worse, but now the odds are much more in my favor. And that's all you could do is put odds in your favor. So I went 100% value. And I was dead wrong for 2 years. Now, a lot of people would panic and sell and get out. Eventually, I was proved right, and value dramatically outperformed. Eventually, I went all to small value, and I did even better because the small stocks, even further outperformed. And that held right up through around 2016 or so. And at the end of 2016 or early 20, the thing reversed. And now we've had growth outperforming. And you got to be able to stay the course, because if you try to time it, you're going to get it wrong and you'll end up selling low after periods of poor performance and buying high after periods of high. And that's a recipe for failure.
The one last thing I just wanted to highlight briefly was about the choices that a company faces, like Intel in the story. And it's just thinking about the framework and the constraints. So when your stock is really overvalued, where you feel or you've calculated, you think that your stock is really overvalued, that means people are willing to pay a very high price for your business, much higher than what you think that business is actually worth. At that point, you want to raise capital because you can sell a lesser amount of shares and get a higher amount of money.
Your cost of capital is lower.
Yep. And so there is a constraint. If you went out and flooded the market with shares and issuance of shares, you could cause people to get nervous, or you could cause them to worry about dilution or their future earnings and all that. So there's a constraint on that side. Of course, on the other side, if you keep the money in the firm and you keep investing it, there's also the constraint that you could run out of, highly profitable opportunities. And if the marginal investment was having a lesser return than the existing assets, that could cause the value of your business to fall. So
that's the empire building problem of big corporations. The CEO wants to justify higher pay, go out and make acquisitions, which on average tend to do poorly. That we know the evidence is clear. This empire building is a problem.
And then the third one is the idea of, well, I think that we've done an internal calculation. We think our business is worth about 100. And we see it trading in the market at 50. So what are we going to do? We're going to take some of our excess cash and we're going to buy back shares and retire them.
Yep.
Now so of course that has its own constraints, but the thing that's interesting about that too is you're also taking a portion of your money, your cash in your balance sheet, and saying, we're not going to invest that in future growth opportunities.
You could even go another step, as some companies do, and go out and lever up and take on debt to buy back the stock, as some companies have done. And, I think the key here is you have to have a belief that the market is underestimating the earnings, right? As opposed to, the cost of capital, the risk premium better than the market. That's hubris, I think. But if you know things that maybe the market doesn't, you're about to sign a big contract with the government and it's going to generate, all this revenue that nobody else knows about. Well, why not buy the stock cheap then? That's a different story.
Yeah. In fact, in Asia, we have a lot of families that own businesses, and let's just take out the insider trading aspect. Let's just say for a moment that, they've been through 30, 40, 50 years of market cycles. and they see that the market is just absolutely crashed and their share price is just down. And so what these guys will do is they'll go to the bank and say, hey, personally, some of them will actually get money from the bank, buy back shares, announce it, according to the SEC regulations, put those shares as collateral, down for that loan. And then as soon as the share price starts to rise, they sell a portion of those shares and pay back that loan. And now they've increased their ownership of the company from, let's say, 40% to 45%, as an example. And then when they see the opposite happening, when the market's super high, they're like, look, I've been through this for 40, 50 years, and I feel like my business is going to be here for the next 40 or 50 years. And therefore, I'm comfortable making those decisions. That is a very common thing that you see going on, in Asia, for sure.
You see it all over the world.
Yeah. Yep.
I mean, executives are not dumb, and they see if they have a low cost of capital, that's just when you want to issue a lot of equity.
Well, Larry, I want to thank you again for another great discussion about creating, growing, and protecting our wealth. And I look forward to the next chapter. Ladies and gentlemen, the next chapter is chapter 8. Be careful what you ask for. And it starts off with the Midas touch story, which actually I had never heard the full story. So I'm looking forward to going through it. I've read it already, but I'm looking forward to it. So for listeners out there who want to keep up with all that Larry's doing, find him on Twitter at Larry Swedroe. And also you can find him on LinkedIn. This is Your Worst. Podcast host Andrew Stotz saying, I'll see you on the upside.